afternoon and welcome to the Wall Street Crossover Show, which is sponsored by Admiral Markets, and I'm joined by Darren Sinden, who is the market commentator of Admiral Markets, to go through this segment. Got Greece sort of in the background collapsing, but the markets seem to be quite firm.
Yeah, I mean, yes, I think given the sort of geopolitical macro background, I think you'd probably be quite pleased if you're involved in these markets at the moment. You know, everything seems to be behaving itself, even a rally in China.
Isn't it quite useful that the China collapse and the Greek, let's say, collapse that we've just had with returning to trading is over the quiet summer months, or as opposed to, say, in October or some other more controversial time of the year?
Yes, I think probably that there's something to be said for that. I think there's coincidence rather than design, but yes, although of course that could come back to bite us if we saw a more momentous movement in the Chinese market, for example.
Okay, well, let's look over the data released over the morning so far, European session. Okay,
well, we'll just highlight something that came out first of all before Europe opened properly, which was the average cash earnings in Japan. This is a year-on-year figure. Just to avoid any confusion, this is actually a measure of wage growth in Japan. So year-on-year, actually down minus 2.4% versus the prior read of plus 0.7%. So another data point for the Bank of Japan and for Shinzo Abe to ponder, because don't forget, Japan is effectively at a state of full employment with unemployment around 3%. So wages declining. So something is rotten in the Kingdom of Japan, we might suggest. And then over here in the UK, nationwide building society house price index data was released today. Two lines here. First of all, the month-on-month number came in at plus 0.4%, bang in line with the forecast of plus 0.4%, and up sharply from the prior month of minus 0.2%. So house prices appear to be bouncing on that measure. And then on the year-on-year number, growth of 3.5%, in line again with the forecast of plus 3.5%, and just slightly ahead there of the prior read of plus 3.3%. So house prices seem to be rising in value here in the UK.
But not a massive amount.
No, but at least it's moving in the right direction, even if inflation remains somewhat reticent to do so. And then zipping over the channel, we had Spanish unemployment, the change for this month, down by 74,000. Against a forecast of a fall of 45,600. So, in fact, an improving picture as far as Spanish employment is concerned on that measure, except for the fact that the prior read came in at minus 94,000. So we had a bigger drop last time, but still 74,000 less unemployed people in Spain is a move in the right direction.
Right.
And then the last number of consequence, as far as I was concerned today, Eurozone producer price indexes or indices for June. The year-on-year figure, minus 2.2%, dead in line with the forecast of minus 2.2%, and slightly worse than the prior read of minus 2%. But again, the ECB obviously trying to stimulate inflation in the Eurozone. To see producer prices falling quite sharply like that, again, that must give them some pause for thought.
Bit of work to do there, I would say. Okay, and on to the European movers.
Okay, well, I couldn't resist including the first stock on the day that the government started to sell down its stake in Royal Bank of Scotland. The stock is Direct Line Insurance, that's DLGLN, the ticker, 372p, up 1.64%. What's the relevance of this stock in relation to Royal Bank of Scotland?
Used to be part of it.
It did indeed, and it was kicked out in the fire sale of assets, and to some extent I think maybe the baby was thrown out with the bathwater here, because if we look, half one pre-tax profits at Direct Line jumped sharply to £315 million, and it's not bad going in the first 6 months of the year, and contrasts very nicely with the £1 billion loss the government's just taken on the first 5% of RBS it sold. Direct Line has also increased its interim dividend by 4.5%, and that follows the special dividend announced in March, and it gave 27.5 pence per share back to shareholders then. Premiums were flat, so there wasn't much in the way of premium growth at the company, but no major weather events in this winter.
It'd be interesting to know who was in charge of the idea of selling Direct Line Insurance.
It would, some faceless bureaucrat, no doubt. But nonetheless, the market quite appreciative of that, and they're up to say 1.64%. But we're not the only country with banking issues. We chop over the channel to France and look at Crédit Agricole, ticker ACA in Paris. 12 euros 81, down 11% this morning. And the reason for that share price, well, despite reasonable Q2 numbers, the shares were whacked quite hard as the new CEO ruled out a speedy revamp of the bank. And the reason that the speedy revamp was ruled out was due to what were described as constraints highlighted in recent talks with the ECB. And basically what the market's saying is that there's a conflict now between the listed entity, that is Crédit Agricole, and the co-op structure of regional agricultural banks that back it up, and so the market doesn't like what it hears there, and 11% is the initial move, and I suspect there'll be a further bleed in that one going forward. Okay,
so a little bit, a few nasties in there somewhere.
Yeah. Okay.
Right. Okay. Next one.
Right, well, M&A rumours and movers. I thought we'd have a look at a couple of stocks that have been in the news in the last 2 days here in the UK. Smiths Group, which is ticker SMIN in London, and Rolls-Royce, nice and easy to remember, RR. Smiths Group, 12.17 just before we came on air, up 5.92%. Rolls-Royce, 8.41 yesterday, up 5.5%. And why? Well, both stocks have come under the microscope of a US hedge fund called ValueAct Capital. ValueAct has announced stakes in both companies, a 5.4% stake in Rolls-Royce and less than a 5% stake in Smiths Group. I can't say exactly what the stake in Smiths Group is because it hasn't had to disclose that at the moment under our UK rules. ValueAct has become the largest Rolls-Royce shareholder, and is going to seek board representation. And according to press reports, it's said to believe that both of the principal business divisions of Smiths Group could be big targets in their own right. The fund is run by a guy called Jeffrey Ubens, who used to work for Warren Buffett, and he has a reputation for extracting value. And to put that into some kind of context, he achieved, well, I think I'm right in saying, a 2,100% return on his investment in Valiant Pharma. That might be a one-off given the nature of the US drug market, but nonetheless, he's a man who likes to spot value and likes to extract it.
Well, I'm sure there's plenty of value there, but the bosses of both companies probably are rather unlikely to be booted out in favour of extracting too much share power. I mean, we've seen a lot of these companies. I mean, we know there's value in Smiths Group. There's been the GE potential and everything else, but the management there don't really want to move on in those situations.
No, they probably don't. But I think I'd imagine, reading between the lines, that he's hoping to flush out potential bidder, probably for, in the case of Smiths Group. What his strategy is around Rolls-Royce remains to be seen. But he hasn't taken these decisions lightly, I'm sure.
Right. Well, good luck to him. Next up, we've got the US data points.
Okay, a bit thin today after a busy day yesterday, but Red Book chain store sales is our weekly friend in the absence of all else. Comes out on a Tuesday. Recent reads for this have been lacklustre, and it does suggest that we could head back below 1%, having registered reads of 5 and 6% not that long ago. What's interesting here is that despite the decline in these chain store sales, you don't read too much about the health or the declining health of the American consumer. So at some point, presumably the dots will be joined up. And then it's probably slightly more relevant day-to-day factory orders for June, the month-on-month number, forecast to grow by 1.7% against a prior read of -1%. But again, to give this some context, be aware that this has been trending lower since August 14, and if we did get a read of 1.7% or even anything positive, it will only be the second positive read only in the last 12 months. So
you could argue that factory orders are the real economy, is that right?
I think that's probably fair to say. Yes, the traditional US economy rather than the new electronic economy.
Right. Okay. And on to the movers and levels.
Okay, well, pre-market movers, a couple of stocks have taken my eye here this morning. First of all, Integrated Device Technologies, that's ITDI, trading around $20.75 pre-market, up about 8.8%. And basically, the magic mix here, an earnings beat from the company, and it flagged a growth in wireless charging. And I'm thinking here of wireless charging of mobile devices, and I think that is definitely you know, the way of the future, and integrated device technology seems to
I
have.
managed to step back from the brink on that. It would have cost me £80 to get all this this phone charged up wirelessly. I'm go for the old wires at the moment.
No, fair enough, and you know, it's always expensive to be an early adopter, but I think we can all imagine the way that's going to go.
It's the future, isn't it?
And then Cognex Group is our next stock. CGNX in the US, $35 though, trading pre-market, down 22.14%. This just goes to show that it's not all rosy in the world of new technology. Soft, and I think the key here is unexplained Q3 guidance disappoints investors in the machine vision specialist. That Cognex is a group that allows machines to see and read and to perform automated tasks. But as I say, the management downgraded the guidance and didn't really give a full enough explanation as to why that was. So the market's voted with its feet, and they're down 22%. And in terms of levels today, all quiet on the Western Front, as you've suggested. As far as European equities are concerned, FTSE, we're just literally trading around the range here. So 66.30 now, the downside level to watch, plays 67.15. The DAX was a bit better again yesterday, so we're now up to 11,380, plays 11,480. A slightly wide range there, but again, we're looking for proper directional cues. In the S&P, we're back to 2087 on the downside, plays 2105 on the upside, and for the Dow, 17,495 is our downside level, plays 17,599 to the upside, and again that's pretty much just around the range of yesterday's trade. Not much to report as far as euro dollar is concerned. 109.40 now, plays 109.90 to the upside. We have seen a bounce in Aussie dollar against the US dollar after the Reserve Bank of Australia held rates, and the market took that in a more positive light. So 73.60 on the downside now, plays 74.14 on the upside, so a change of big figure there. Dollar yen, 123.80 to the downside, plays 124.08 to the upside, just testing back below 124 briefly perhaps. And in cable, no great shakes, 155.60 to the downside, plays 156.15 to the upside, so pretty much as we were yesterday.
So all rather calm. Right? There's not really too much to upset the summer feel.
No, we might see something in cable on Thursday, when of course we've got the first of these Bank of England Super Thursdays, where the data, where the decision and the data is all going to be released together. So that'll be quite interesting. But for the moment, as you said, all quiet on the Western Front.
Right, well, thank you very much, Darren Sinden, market commentator at Admiral Markets. That closes the Wall Street crossover show, and we'll be back tomorrow at the same time.